Hello and welcome to the special show. I am Anuj. With me, of course, is Prashant, and we have a special guest joining us. Ramdev Agarwal, Chairman and co-founder of Motilal Oswal Financial Services, is here right in our studio. Ramdev, good morning. Always a pleasure, and things are back to normal. You are in our studio.
Yes.
We would have hoped that, once this pandemic was over, things were really normal, but now this war has come on us. So something is bothering the market, whether it was pandemic or whether it's the war.
Yeah.
First of all, great to have you. Your thoughts on, what we've gone through.
Yeah, so we were hoping that we'll have a wonderful 22-23. I mean, 21-20 has gone again in fighting COVID, and we'll have a wonderful peacetime 22-23. And risk, one thing I have seen that whatever you think is the risk, that is not the risk. Risk is something which is not visible. So you have to be always prepared for something. We are saying that, okay, war is over, or war would be over, or COVID is over, but something else is kind of brewing somewhere. So I think the risk has played fully, and risk assets have suffered in last 30 days or so. So I think one set of risk play out is maybe at the peak or coming to an end, and then we'll start. And I think we have to prepare for the peacetime now.
Prepare for the peacetime, portfolio-wise.
Yes.
Ramdev, so, two questions. One is what everybody wants to know.
Yeah.
Is the worst somewhat is visible? I mean, what we've seen in terms of the price damage we've seen. And second, we were in absolutely no doubt that this was a roaring bull market till last year. Has that uptrend been broken, or you think this is just a pullback in that uptrend? Because when you're in the midst of that pullback, it seems like, I mean, the world is completely sort of gone for a sixer. What's your sense?
So clearly, I mean, the problem is not over, and in what shape it will be over, what will be the lingering sanctions and the world order which is kind of vitiated right now, and it has its own cost in the sense that sanctions, if they continue in whatever form, and things will settle down. I mean, once you have created such a big kind of disturbance, it will take its own time to settle down. So the commodity prices, oil prices, gas prices, and a lot of economics of a lot of businesses have gone topsy-turvy. And consumers may not be willing to pay the pass-on cost. So I think we have to assess over the quarters which are the businesses which have done well, or which have done well and which are actually suffered and will suffer in the day, many quarters to come. So that assessment will happen, but my sense is that we have seen the worst of it is the stock market. I mean, one is what is happening in Ukraine, USSR. Second, what is happening in stock market front, that is more than $1 billion daily selling by FI, because that is a real war for us.
Yes.
We have to face that every day.
Absolutely.
So I think that we have faced brilliantly. So they have had a wonderful exit from India, I would say, but I think they will have very painful entry if at all they want to enter.
Okay, yeah, and that's an important point, right? $1 billion a day, and it's being absorbed, Ramdev, right?
3-4 days continuous.
3-4 days continuously. I mean, if it was a market of say 2007 or 8, we would have seen
it's a completely structural change. There's a complete change. I don't know who all are buying. Of course, retail is there on one side, but
retail is there, and DI is also at the end of the retail, right?
They're also retail. Yeah.
Absolutely. So that is my question then, Ramdev, and we of course don't know. We'll always be wiser with hindsight, whether it was just a fall or a bigger fall or a bear market. We don't know.
Yeah.
But is this a bit of a risk for the market, because a lot of this money has not seen a bear market? I mean, a lot of first-time investors are there, and they have put a lot of money. So do you see that emerging as a bit of a risk?
Yeah, that's a risk, because the behavior can be quite crazy. I mean, you can push them to a particular extent. After that, when they break down, everybody will break down together. But this time, the fixed income has also collapsed. So you don't have a place to hide. I mean, when you leave the equities, you end up in 5% kind of a post-tax return, which is also not acceptable to the people. In fact, one of the reasons they have come in, apart from retail, is that collapse of fixed income. So I think that fixed income is not going back to say 7-8%, 9%. So there is no logical transfer from equity asset class to permanently into the fixed income side. So I would say they might stay back for the time to come, but they will whenever the market starts recovering, because they know only price, they don't know value.
Yeah,
this crowd doesn't know value. This crowd knows only price momentum.
Yes.
So as the prices stabilize and they start moving up, they will come with double speed, because now, boss, we've got it and we have now trained.
Just to follow up, so you reckon this selling is more from the momentum ETF kind of funds and not the long only funds?
That's what I get to hear, that they are emotionless while selling, and they will be emotionless while coming also. You know?
No, you said that the exit has been wonderful, but
Yeah.
their exit, but entry will be painful.
Very painful.
Which means you are anticipating a ferocious comeback as well for
I would
markets.
think so. But it all depends on how things shape up in the sense that how suddenly, you know, war stops. I mean, there is a this thing, you know, what do you call, withdrawal of the troops or something like that, dramatic withdrawal of the sanctions and all. So we don't know how things will shape up. But markets are markets in the sense that once the markets, they realize that we have got over the peak of the problem, then they will start rallying.
You know, just one thing, there is more and more sort of people who study this thing are starting to believe that even if the conflict on the ground stops, it's not as if commodity prices will all revert back to pre-conflict
Yes,
levels.
yes.
Maybe they'll stay higher for much longer. Is that baked into in your assessment of?
Prashant, it is very tough to figure out the damage done. I'm telling you, it is, as the time comes by, we'll realize that the weaker industries have become weaker, and weaker companies in those weaker industries have become worst. Okay, and the stronger industries will emerge stronger out of this crisis again. And among those stronger industries, stronger companies will emerge even strongest. So we have to see. We can do nothing about the external environment. This is a ground given to us to manage money or invest and make money. So what happens to the corporate earnings? I think ultimately we have to figure out where the corporate earnings are going. We were thinking that it will be upwards of 875, 885, 890. Post budget we had come to almost 890, 900 we were fiddling with. So I said 18,000 looks to be fairly priced kind of a index. And now you are at 15, 16,000. So I think you have a good play if things settle down, and still earnings for 22, 23 is broadly intact.
Yeah, I mean, I use the Motilal estimate, of course, for arriving at that index number as well. But Ramdev, you know, just getting back to your last question, you said fixed income is not coming back anytime. But you know, even before this Russia-Ukraine war started, market had started to fall, and you know, one big risk factor was. Even before this, inflation was already rising, and you know, Fed was clearly going to rise rates. And there's still jury still out on how much they'll raise. But before the war, it was clear that they might even raise 50 basis points. So, in that sense, how should people position their portfolio, given that, you know, the ultra low interest rates environment might be behind us?
Yeah, in fact now it has become worse because the inflationary pressure which was there, that is further exacerbated by higher commodity prices across the board, and speculators, they are best in doing this in the sense that what the oil price should be 110, it will go to 150 if they can squeeze you as much. So that's what is happening right now. So I mean, clearly inflation situation become worse, but how much of demand destruction is going to happen, and what kind of a post-war economy, world economy we are going to see, and what kind of, world is very interdependent, whether you like it or not. I mean, the world is, the NATO allies are dependent on China and Russia, and China and Russia is also dependent on other side. So they have to accept this fact, and then at some point of time they'll realize that enough is enough. Let's get back to the taking care of the economy. So I think right now it is punishing the economy the top priority rather than taking care of the economy. So I think as the settlement happens, the whole thing will change. And so I think investing has to be bottoms up right now. To say that this sector is going to be, I mean, yes, at one level you can say, but still I think a lot depends on the strength of the companies, how they are going to negotiate this entire turmoil.
You said some companies sectors will get stronger, companies within will get even stronger, and vice versa. We had a significant fall, I mean, topsy-turvy all over the place. Which are, to your mind, looking very strong out of this?
See, fundamentally, I think services will do better than manufacturing, because all this raw materials go into manufacturing. So who's hit where and how much? Who knows? You know, so that you have to do company-wise assessment in manufacturing. You know, if you're using too much of nickel, I don't know what is going to happen to that company's raw material cost, and can you really pass on? So, you know, overnight you are negative territory. Cement company, they are in current cost structure, they are negative territory. I mean, so how they come back, how much they are able to pass on. So those things we have to see. But at the same time, services companies like, say, IT, banking, insurance, all these companies are broadly not impacted. Even broking, I mean, we see that it is not impacted. So yes, mark to market, the losses to the customers, their own sentiment, that is going to hurt for sure in the short run. But broadly, the business model is not impacted.
Services over manufacturing.
Okay. Are you surprised by this near collapse of the big banking names, Ramdev? Of course, you know, the easy thing to say is it's FII selling. But names like HDFC Bank hitting 52-week lows, Kotak Mahindra Bank for a good period of 12 to 18 months doing nothing, underperforming the market.
I would think that they are in a very sweet spot, I'm telling you, as a business-wise. They are the 4-5 banks who are going to underwrite the entire India growth story. And the asset quality fully provided, credit cycle is on an upward swing, and credit cost cycle is on the downward swing. What more do you want? And then there is a 15-17% natural growth.
It's not reflecting in the stock price.
It is not reflecting because of this FI selling. I mean, see, they own 70-75% of all these banks. So when they have to, index-wise, they have to hit. They have to, I mean, I think close to 27-28% is banking in India. And
Yes.
all private sector banks they have.
Yes, yes.
So when they sell index, that much sale comes on these companies. And once the retail also knows that here the flow is coming, he would also stay back.
Yes.
Absolutely.
And that creates big value. See,
Yeah.
this is the time where now the guys who are thinking that it is expensive, it was expensive, the market at some point of time. Now, selective value picking must happen from the growth stocks.
Got it.
Okay, got that. Ramdev, stay with us. What we'll do is we'll take a quick break here. We come back and we'll bring in two gentlemen from diverse sectors, Anil Singhvi of Sri Digvijay Cement, for a discussion